Most people pick a bank once and never look back. That's exactly what the banks are counting on. I spent 15 years inside the industry, and what I saw would make your stomach turn. Hidden fees, illegal charges, junk fees on accounts people didn't even open. 7 of the biggest names in banking are about to be exposed. 3 are going to restore your faith. Number 7, TD Bank. TD Bank likes to sell itself as America's most convenient bank. Convenient for who, exactly? Because the data tells a different story. In 2025, TD Bank extracted around $18 per account per year, purely in overdraft fees. That might not sound like much, but multiply it across millions of customers, and you're talking about hundreds of millions of dollars pulled quietly from people who are already running low. And here's the part that should concern you. Between 2023 and 2025, TD Bank increased its overdraft revenue by 22%, not decreased, increased. While other banks were cutting fees under regulatory pressure, TD was quietly leaning harder into them. No big scandal, no front-page fine, just a slow, consistent grind on your account balance while the marketing department kept telling you how convenient everything was. And TD isn't alone in that mid-sized bank game, but the next one took it further. Number 6, USAA Federal Savings Bank. USAA has one of the most powerful brands in American banking. It was built on a promise to serve military families, people who deploy overseas, manage finances from combat zones, and deserve institutions they can actually trust. For years, USAA delivered on that. Then, in late 2023, something changed. USAA introduced overdraft fees for the first time, and not just any fees. Within 2 years, USAA had the largest percentage increase in overdraft revenue of any major bank in America. They went from 0 to one of the fastest-growing overdraft machines in the country. When a brand built on service to veterans starts harvesting junk fees from the same people it promised to protect, that's not a business decision. That's a betrayal. The military branding gets worse before it gets better, because number 5 also wore a badge of trust. Number 5, Navy Federal Credit Union. Navy Federal markets itself as the credit union for service members, veterans, and their families. The largest credit union in the United States. A nonprofit. A community. In theory, the opposite of a fee-hungry bank. In reality, from 2017 to 2022, Navy Federal collected nearly $1 billion in overdraft fees. Not from corporate clients, from enlisted personnel, veterans, military spouses. The Consumer Financial Protection Bureau investigated and found that Navy Federal was charging illegal overdraft fees, cases where customers had enough money in their account when the transaction was approved, but by the time it posted, the balance had shifted, and the fee hit anyway. The enforcement action forced Navy Federal to refund more than $80 million to members and pay a $15 million civil penalty. $95 million total. For a nonprofit credit union that claimed to put members first. From military families to middle America, number 4 hits a different kind of customer. Number 4, Regions Bank. Regions Bank operates across the American South and Midwest. Not a flashy coastal brand, but a deeply embedded regional institution that millions of households rely on. And Regions has been caught doing the same thing twice. In the period between 2018 and 2021, regulators found that Regions was charging overdraft fees on transactions that customers had specifically been told were covered. The bank approved the purchase, told the customer the money was there, then posted the transaction in a way that triggered an overdraft fee anyway. That practice, called authorized positive, settled negative, is one of the most cynical fee tactics in the industry. The settlement cost Regions $141 million in customer refunds and a $50 million fine. Then look at the 2025 data. Regions Bank still had the highest overdraft fee revenue per account among large banks, around $30 per customer per year. $30 per customer is bad. What comes next is billions. Number 3. JP Morgan Chase. JP Morgan Chase is the largest bank in the United States. It has never had a fake account scandal like Wells Fargo. No single headline grabbing enforcement action has defined it the way others on this list have been defined. But here's the number that matters. In 2023, Chase collected approximately $1 billion in overdraft fees, more than any other bank in America. $1 billion. From customers who went negative by a few dollars, sometimes for a few hours. Chase charges up to $35 per overdraft transaction, one of the highest rates in the industry. And while competitors were cutting fees to protect their reputations, Chase was still pulling close to $1 billion a year from the practice. The quiet giant. No scandal, just scale. When you're the biggest retail bank in the country and you're still running an overdraft machine worth $1 billion annually, the math speaks for itself. From scale to scandal, because the next two didn't just charge you, they lied to you. Number 2, Bank of America. Bank of America was fined $150 million in 2023 by the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency. Here's what they actually did. First, they double-charged customers with insufficient funds, hitting the same transaction with an insufficient funds fee multiple times. Second, they opened credit card accounts in customers' names without their knowledge or consent, then charged fees on those accounts. Third, they withheld cash rewards that had been promised to new customers. This wasn't one rogue branch or one bad quarter. Regulators found these practices were systemic, affecting hundreds of thousands of customers across multiple product lines. When you add in earlier settlements and class action agreements, Bank of America's total junk fee and fake account exposure runs to over $230 million. They charged you for accounts you didn't open, then charged you twice when you ran short. That is not a fee structure. That is a trap. Everything you just heard, and it still isn't the worst. Number 1 made all of them look like amateurs. Number 1, Wells Fargo. Wells Fargo is in a category of its own. Between 2011 and 2016, employees opened more than 3.5 million fake bank accounts and credit cards in customers' names without consent, without knowledge, without any request. Customers were being charged fees on accounts they didn't know existed. The pressure to hit sales quotas was so extreme that 5,300 employees were eventually fired. The initial Consumer Financial Protection Bureau fine in 2016 was $185 million. That was just the beginning. In 2022, the Consumer Financial Protection Bureau issued a $3.7 billion enforcement order against Wells Fargo, the largest fine in Consumer Financial Protection Bureau history at that time, covering illegal surprise overdraft fees, misapplied loan payments, wrongful auto repossessions, and improper mortgage servicing, multiple product lines, years of abuse, and yet, in 2025, Wells Fargo was still collecting approximately $924 million in overdraft fees, about $15 per account per year, placing it near the top of the overdraft revenue tables. They paid $3.7 billion in fines. They kept the model running. Wells Fargo is not a bank that made some mistakes and fixed them. It is a bank that has been caught, fined, and caught again. Now take a breath, because not every bank is playing that game. Number 3. Discover Bank. In 2019, Discover Bank did something almost no major financial institution had done before. It eliminated every single fee on its deposit accounts. Not reduced. Eliminated. No monthly maintenance fees, no overdraft fees, no stop payment fees, no excess withdrawal charges. Discover's overdraft fee had been $30, gone. The average American was paying around $13 a month in checking account fees at the time. Discover made that zero. The model works because Discover's banking arm is lean and digital first. No sprawling branch network to fund, no aggressive cross-sell quotas, just a straightforward account with clear terms and no hidden line items waiting to catch you off guard. Discover set the standard, but number 2 took the same model and added something extra. Number 2, Ally Bank. Ally Bank is entirely online, no physical branches, which sounds like a limitation until you realize that branch infrastructure is exactly what traditional banks use to justify their fee structures. Ally's model eliminates that overhead and passes the saving directly to the customer. No monthly maintenance fees, no minimum balance requirements, no overdraft fees. On top of that, Ally reimburses up to $10 per month in ATM fees charged by other banks and gives access to approximately 43,000 surcharge-free ATMs through the Allpoint network. Ally also pays interest on its checking account, so while other banks are taking $35 when you go negative, Ally is actually paying you to hold a positive balance. It is not a gimmick. It is a fundamentally different approach to what retail banking can be. One bank did everything Ally and Discover do, and then went further by being the first major U.S. retail bank to make the call publicly. Number 1, Capital One 360. In 2022, Citigroup became the first major U.S. retail bank to fully eliminate overdraft fees, a landmark move. But Capital One 360 earns the top spot here because it combines the complete elimination of overdraft fees with no overdraft fees, no monthly maintenance fees, no minimum balance requirements, and access to one of the largest fee-free ATM networks in America through its Capital One and Allpoint network. When a transaction would overdraft your account, Capital One simply declines it. No fee, no penalty, no $35 surprise the next morning. The account works the way a bank account should have always worked. Capital One is not a small digital startup trying to disrupt the industry. It is one of the largest banks in the United States, which makes the choice to walk away from overdraft revenue all the more significant. They prove that a major bank can be profitable without harvesting fees from customers who are already struggling. The banks at the top of this list didn't stumble into junk fees. They built systems around them and fought to keep them. The 3 at the bottom proved those fees were always a choice, not a necessity. Like and subscribe for more.